All right, so gold and silver got crushed today, and they both took a huge hit. And it wasn't because of demand collapse or some geopolitical tension, it was because of the CME. Prices were skyrocketing, and the CME did not like how fast things are moving, so they raised the margin requirements, and boom, metals sold off instantly. So Monday morning, silver futures dropped about 8%, gold fell around 5%, and copper slid too. The reason is pretty simple. CME told traders they now have to put up more cash to trade metals. If you're not familiar with the margin requirements, here's an easy explanation. When you trade futures, you don't have to pay the full value up front. You just put down a deposit margin, and the exchange wants to make sure you can cover your losses if the trade goes against you. So when prices move too fast, exchanges get nervous, they raise their margin. That forces traders to either cough up more cash or close their positions. And a lot of us are broke, so we all close our positions. And guess what? Prices fell fast. The CME raised margins because of market volatility. Gold and silver were running way too hot. Gold is up about 65% this year, and silver has more than doubled. Silver even hit levels we haven't seen since the 1980s, back when traders literally tried to corner the silver market. So the CME stepped in to cool things off, aka they're bears, they're shorts. Nah, I don't know, I'm just kidding. Rally isn't random though. There's two big forces behind it. Supply is tight. Major mines have been slowing production, inventories are low, and there isn't a lot of silver to go around. Demand is also booming. Solar panels need it, data centers need it, electronics need it. So you got shrinking supply, rising demand, and silver is going to the moon. Silver this year started around $30 an ounce, and it briefly touched $80 on Friday. That's insane. Gold's been running too, but gold's not about industry. Investors have been worried about geopolitical tensions, market bubbles, and overall uncertainty. So when they get nervous, they go to gold. It's a classic safe haven move. But silver sometimes gets called the poor man's gold because it tends to follow gold's pattern, just with way more volatility. And that volatility is why the CME stepped in. So, what happens next? When exchanges raise margin requirements, it usually causes short term pullbacks, which is exactly what we saw, but it does not necessarily mean it killed the long term trend. If silver demand stays strong, supply stays tight, if gold keeps getting safe haven flows, then this could just be a reset, but not the end of the rally. But for now, CME tapped the brakes on the silver rally. So silver and gold did not fall because of fundamentals change. They fell because the CME raised the cost of trading them. And it's a reminder sometimes markets move not because of supply and demand, but because of rules around how things are allowed to trade. If you like this video, please subscribe and give me a thumbs up. I'd really appreciate it. Peace.